As we head toward the North American market open on October 23, 2025, the U.S. market is currently closed. Denison Mines Corp, ticker DNN, finished yesterday's session on October 22 perfectly flat, closing at $2.72 per share, with zero change. Early pre-market indications show that static price holding, with no trades yet registered to move the needle. Now, seeing a stock at a dead standstill, especially a volatile name in the uranium sector, might make you think it's just a dead air day. You might assume the market has lost interest and is focused on big tech earnings, maybe what Apple stock is doing, or if Nvidia stock can continue its run. But the expectation that this $2.72 flatline means apathy could not be more wrong. The reality is this price doesn't represent apathy, it represents tension. This is the price of a market collectively holding its breath, because Denison Mines is right now in the middle of the single most important regulatory process of its entire existence. Most investors, especially those new to the uranium space, perhaps using the Robinhood app or a SoFi Invest account for the first time, look at Denison as a straightforward, leveraged bet on the commodity. The thesis is simple. The world needs clean baseload power. Nuclear energy is the obvious answer. This creates a structural deficit for uranium, the fuel. The spot price of uranium, U308, has responded, holding firm at strong levels, recently seen around $76 per pound. The expectation is that as this price grinds higher, a developer like Denison, which owns massive deposits in the ground, will see its stock price multiply. This is the common belief, and it's not incorrect, it's just dangerously incomplete. The reality, and what separates a surface-level investment from a deep analysis, is that the spot price of uranium could hit $200 tomorrow, and it would mean absolutely nothing for Denison's long-term future if they cannot get a license to mine their flagship asset. This stock is no longer just a bet on the spot price. It has matured into a binary regulatory event. What's happening right now is that Denison is navigating the final federal hurdle for its Wheeler River project. We already got the fantastic news back in August that the provincial environmental assessment for Wheeler River was approved. That was a huge de-risking step. But the final boss is the Canadian Nuclear Safety Commission, the CNSC. The public hearings for the federal environmental assessment and the crucial license to prepare, site, and construct are happening as we speak. The first part of that hearing was scheduled for earlier this month, October 8th, and the second final part is slated for the week of December 8th, 2025. This $2.72 closing price is the market's consensus bet on the outcome of that December hearing. Every day that passes, every piece of testimony, every analyst note is being scrutinized not for what it means about the price of uranium, but for what it implies about the CNSC's final vote. This is where the real story is, and it explains the stock's recent, seemingly confusing behavior. Let's look at the chart. This $2.72 close comes after a significant pullback. Just last week, on October 16th, DNN stock touched its 52-week high, hitting $3.42 intraday. The volume on that day was absolutely massive, clocking in at over 135 million shares. We saw similarly huge volumes in the preceding days, well over 100 million shares changing hands on the 15th as well. Since that peak, the stock has bled off, dropping from $3.42 down to $2.72. That's a steep 20% haircut in less than a week. The expectation is that something must be wrong. Did the company announce bad news? Did the uranium thesis break? No. The reality is this is classic, predictable behavior ahead of a major binary event. The run-up to $3.42 was fueled by a string of incredible news: the provincial approval, the successful closing of an upsized $345 million convertible senior notes offering in August, which secures their financing for construction, and even news of a new high-grade mineralization discovery at the Griffin deposit outside the known resource area. All this good news created a surge of buying, but the traders who bought at $250 or $280 are now looking at the calendar. They see the final CNSC hearing in December. They understand that while the provincial approval is a strong positive indicator, the federal decision is not a guaranteed slam dunk. So what do? They sell. They take their profits off the table before the hearing, unwilling to gamble on the outcome. This selling pressure from short-term traders is what has driven the stock down from $3.42 to $2.72. This isn't long-term investors at Fidelity or those using Schwab Intelligent Portfolios dumping their core positions. This is fast-moving capital de-risking. In fact, if you look at the analyst ratings from institutions like TD Cowen, Canaccord Genuity, and Scotiabank, the consensus remains overwhelmingly buy or outperform, with price targets well above the current price. They are modeling for success. The current stock movement is simply the tension between short-term profit takers and long-term thesis-driven holders. For those who aren't familiar with the company, let's quickly establish what Denison Mines actually is. This is not a massive, established producer like Cameco. It is a uranium exploration and, more importantly, a development company. Its entire valuation is pinned to one asset, the Wheeler River project in Saskatchewan's Athabasca Basin, the single best jurisdiction on the planet for high-grade uranium. Denison has an effective 95% interest in this project, which itself is composed of two major deposits, Phoenix and Griffin. Phoenix is the real prize. It is designed to be an ISR, or in-situ recovery mine. This is the core of their entire story. Instead of a massive, traditional open pit or underground mine, ISR involves drilling wells into the ore body, circulating a solution to dissolve the uranium underground, and then pumping that uranium-rich solution back to the surface for processing. It is considered to be far more environmentally friendly, with a smaller surface footprint and lower capital cost. This ISR method is precisely what the CNSC is currently evaluating. The provincial approval suggests the method is sound, but the federal commission has the final say. While Wheeler River is the future, Denison isn't just a blueprint. They have other valuable assets. They hold a 22.5% interest in the McLean Lake joint venture, which is operated by the French nuclear giant Orano. The McLean Lake Mill is one of the only active uranium mills in Canada, and back in August, Denison announced that the joint venture had successfully achieved its first production at the McLean North deposit using a new mining method. This is significant. It means Denison is already seeing cash flow from a returning to production asset, which helps fund its overhead while it develops Wheeler River. They also have a large portfolio of other exploration projects and, very shrewdly, a physical stockpile of about 2.2 million pounds of U3O8, which they bought years ago at an average cost of just $29.66 per pound. With the spot price near 76, that physical stack alone is a very valuable strategic asset on their balance sheet. This isn't a one-trick pony, but make no mistake, the multi-billion-dollar valuation comes from Wheeler River. This brings us to the future outlook and the clearest case of expectation versus reality you will find. This is not like trying to guess the next iPhone sales for Apple stock or data center demand for Nvidia stock. Those are exercises in nuance. This is a binary outcome. Path 1 is the bull case. The expectation here is that after the December 8th hearing, the CNSC, having reviewed the successful provincial EA and the extensive de-risking data from Denison, grants the license to prepare site and construct in early 2026. The moment that license is granted, Denison Mines is no longer a developer. It becomes a mine in construction. The single greatest risk associated with the stock, permitting risk, is instantly removed. The $345 million in financing is ready. The engineering work for Phoenix is already reported to be roughly 80% complete. They could, in theory, break ground almost immediately. In this scenario, the stock will not just drift higher, it will re-rate violently to the upside. Analysts will have to update their models from speculative developer to near-term producer, and the stock's value will rocket up to reflect the net present value of a fully permitted, fully financed, high-grade ISR mine in a $76+ uranium market. People who bought at $272 on their Robinhood stock trading platform or through their Interactive Brokers account will be looking at a multi-bagger. Path 2 is the bear case. The reality of any regulatory body is that a no is always possible, or perhaps more likely, a not yet. The CNSC could come back and say the ISR data is insufficient. They could demand another